Nike is trading at $40. That is not a typo, $40. A year ago it was $74, and on Monday after the bell, they report earnings. The options market thinks this is an 8.6% move. History says it should be 8.9. That gap matters, and I'm going to show you exactly how to use it. Hey, I'm Jaden, and this is where we break down what really moved the market, the way nobody else will. None of this is financial advice. It is the story behind the numbers. Look at this chart. Nike has been in freefall. From $74 last October down to $40 today. That is a 45% decline. Tariff headwinds, inventory problems, a CEO transition that hasn't landed yet. The stock just hit its 52-week low heading into earnings. So here's the question every options trader should be asking. Is this stock going to move big on earnings? Because when a stock has dropped this far and this fast, you tend to get one of two things. Either a relief rally on any good news, or a total capitulation if things are worse than expected. Either way, that is a big move, and the options market is actually underpricing it. This is the key chart, implied versus historical earnings moves for the three names on the scanner this week. Look at Nike, the options market is pricing in an 8.6% move, but the last 5 earnings reports averaged 8.9%, that is underpriced. 2 of those 5 reports moved more than 10%. Now look at Delta. The implied move is 8.4%, but historically Delta only moves 3.5% on earnings. That is massively overpriced. Same signal, opposite trades. So for Nike, the play is a long straddle. You buy both a call and a put at the $40.50 strike, expiring July 2nd. 2 days after earnings, total cost, $3.46 per second hair. Your breakevens are $37.04 on the downside and $43.96 on the upside. If Nike moves more than 8.5% in either direction, you profit. If it doesn't move, you lose the premium, $3.46. That is your max risk. Now, here is why I like this setup specifically. When a stock is sitting at a 52-week low with this much uncertainty, tariffs, inventory, new leadership, the distribution of outcomes is fat-tailed. 2 of Nike's last 5 earnings move more than 10%. The straddle only needs 8.5. You are getting paid to bet on uncertainty, and there is plenty of uncertainty here. Now let's flip the script completely. Delta Airlines, the opposite picture. This stock has gone from $56 to $93 in 9 months. That is a 66% rally. It is at its 52-week high heading into earnings on July 10th. Summer travel demand, fuel costs cooperating, capacity discipline, everything has been going right. So when everything is going right and the stock is at all-time highs, what happens to implied volatility? It gets inflated. People overpay for protection. The options market is pricing in an 8.4% move for Delta, but historically this stock only moves 3.5% on earnings. That is 139% premium. The market is pricing in a move that is almost 2.5 times what Delta typically delivers. So for Delta, you sell an iron condor. Short the 99 call, buy the 105 call for protection. Short the 86 put, buy the 84 put. You collect $1.22 in credit. Your break-evens are 84.78 and 100.22. Delta needs to move more than 7.8% up or 6.5% down to breach those levels, both well beyond the historical average. Max risk on the put side is 77 cents. On the call side, it is 4.78. 2 earnings reports, 2 completely different setups. Nike, buy volatility because the market is underpricing the move on a stock in crisis. Delta, sell volatility because the market is overpricing the move on a stock at all-time highs. Same week, opposite logic, both driven by the gap between what the options market expects and what history says actually happens. That is the edge. That is the real story. Now you know how it actually worked. I'm Jaden. Thanks for watching.